All right, let's get right into it. You know, a lot of public servants out there are banking on their student loan forgiveness being totally tax-free. And on the federal level, they're right. But here's the catch. There's this messy patchwork of state laws that creates what's basically a tax bomb. And it can really catch you by surprise. So today, we're going to break down exactly which states are taxing this forgiveness, and probably more importantly, why. So here's our game plan. We're going to take a methodical walk through this tax minefield. We'll kick things off with the federal foundation, just to make sure we've got the baseline rules down. Then, we'll see exactly how the states start to break away, which is what leads to these tax bombs. We'll do a deep dive on Mississippi, and then we'll look at North Carolina and Wisconsin to see the different ways this can play out. And finally, we'll cover a potential way out for borrowers, and this really critical reporting trap called phantom income. Okay, first things first, we absolutely have to understand the default rule at the federal level, because pretty much everything else we're going to talk about is built on top of this one core idea. So the starting point for all of this is right there in the tax code, Internal Revenue Code Section 61A12. And what it says is pretty simple. If a debt you owe gets forgiven, the IRS sees that forgiven amount as income. Period. That means without some kind of special exception, any student loan forgiveness would be taxable. Now, this is where it gets really interesting. Think of it like there are two separate doors people can use to get out of paying that tax. Over on the left, you've got IRC Section 108F1. This is the permanent, built-into-the-system exemption specifically for public service loan forgiveness. On the right, you have Section 108F5, which is more like a temporary shield created by the American Rescue Plan Act. It covers other types of forgiveness, like from income-driven repayment plans. And let me tell you, this distinction between the permanent door and the temporary one is the absolute key to this whole puzzle. So you're probably thinking, if federal law has these really clear exemptions, what's the big deal? Well, the problem just explodes when you get down to the state level. This is where tax codes can lag behind, or states can deliberately opt out, or sometimes they just ignore the federal rules completely. And this really shows the three main traps people can fall into. First, a state might just not conform to federal rules at all. Or it might have what's called static conformity, which basically means its tax code is frozen in time before a new federal law was passed. And finally, a state can selectively decouple, which is where they generally follow federal updates, but then pass a very specific law to carve out and tax something that the feds just made tax-free. Okay, let's see how this works in the real world with our first case study, Mississippi. It's the ultimate non-conformity state, and because of that, it creates a uniquely tough situation for its public servants. And yeah, that's a pretty stark fact. Out of all 50 states, Mississippi is the only one that actually taxes public service loan forgiveness. And, you know, this isn't some accident or a simple oversight. It's a direct result of the way they've structured their state tax code. So here's the technical reason. If you look at Mississippi Code Annotated Section 27-7-15, you'll see it defines what gross income is on its own terms. It doesn't use the federal definition as a starting point. And because the state legislature never passed a law to adopt those federal exclusions from IRC Section 108F, either for PSLF or IDR, all forgiveness just gets treated as taxable income by default. And the crucial point is this. A teacher or a nurse or a firefighter in Mississippi who finally earns their PSLF can see that huge forgiven loan balance get hit with the state's 5% tax rate. I mean, think about it. For $100,000 in forgiveness, that could mean a surprise tax bill of several $1,000s, a bill that their colleagues in all 49 other states just don't have to worry about. All right, let's switch gears and look at a situation that's a bit more subtle, but honestly just as confusing. States like North Carolina and Wisconsin, they don't tax PSLF, but they do tax other kinds of forgiveness, and they do it through these different kind of sneaky mechanisms. Now, this is a direct quote from North Carolina's tax code, and it's a perfect example of selective decoupling in action. What happened here is the legislature passed a very specific law that tells taxpayers to find the student loan forgiveness that was excluded on their federal return and then add it back to their income for state tax purposes. But here is the absolute linchpin. You have to look at the specific code section they're referencing, 108F5. Remember that one? That's the temporary ARPA exclusion for IDR forgiveness. The law says nothing about 108F1, the permanent PSLF exclusion. And since North Carolina's code already follows that older permanent rule, PSLF stays tax-free. It's a trap set specifically for IDR recipients. Wisconsin shows us the other kind of trap, static conformity. Their state law adopts the federal tax code exactly as it was on December 31st, 2020. Well, since the American Rescue Plan Act, with that temporary 108F5 exclusion, wasn't passed until March 2021, that rule just doesn't exist in Wisconsin's code. It's like it never happened. But the permanent PSLF rule from 108F1, that one does exist. So you get the same result as North Carolina, but for a totally different reason. So, if you're a borrower in one of these states and you're staring down a sudden, unexpected tax bill, is there any way out? Well, the main line of defense comes from a concept in federal tax law called the Insolvency Exclusion. Under IRC Section 10A 1B1, you're allowed to exclude canceled debt from your income up to the amount by which you are insolvent, and it's really just a simple balance sheet test. Right before the moment of forgiveness, you add up all of your liabilities, everything you owe, and you subtract the fair market value of all your assets. If your debts are more than your assets, you're considered insolvent. But, and this is a huge but, this defense has a massive catch. For this calculation, assets includes the full value of your retirement accounts. This means someone could have saved diligently into a 401k but have very little cash on hand, and on paper, they'll look solvent. This makes them unable to use this exclusion, even though they have no liquid money to actually pay the tax bill. And that brings us to the final piece of the puzzle, and it's a practical nightmare for borrowers in these states. How are you even supposed to know you have to report this income in the first place? I mean, normally, if you have a debt canceled, the lender sends you a Form 1099-C. But for student loans right now, that's just not happening, and it's creating a huge compliance headache. The reason why is IRS Notice 2022-1. To stop a wave of confusion at the federal level, the IRS basically told lenders, hey, don't send out 1099-C forms for this type of forgiveness. And while that was a really sensible move for federal taxes, it had this massive unintended consequence of hiding the taxable event from people in the states that do tax it. And the result is what we call phantom income. It's a real taxable event that shows up on your state return, but you get zero official paperwork for it. The burden is completely on you, the taxpayer, to know the law, to calculate the income, and to report it. If you don't, you're risking penalties and interest down the road. So to pull this all together, this summary table really paints the picture of the current landscape. Federally, everything's cool, tax-free, at least for now. But then you look at the state level and you can see the split. Mississippi is in a league of its own, taxing everything because of non-conformity. Then you've got states like North Carolina, Wisconsin, and Indiana, where PSLF is safe, but that IDR forgiveness gets taxed through those different tricks, like decoupling or static conformity. And all of this leaves us with one final, really critical question. That whole federal shield for IDR forgiveness, Section 108F5, is temporary. It expires at the end of 2025. So what happens then? Could this state tax bomb problem suddenly become a nationwide federal tax bomb? Well, that's the cliffhanger we're all waiting to see play out.